I think we're live again, Lorraine, for our 5th podcast. And our 5th podcast is going to be about trusts. Mm-hmm. But first of all, you're going to have a brief outline on inheritance tax.
Yeah. So inheritance tax, people know it as the tax that you pay on death. There are also occasions where you pay it in lifetime as well, which we'll look at. Who pays UK inheritance tax? So that is anyone who's always lived in the UK, but also people who might not live in the UK, but they have been resident in the UK for the last 10 out of 20 years. They will also pay UK inheritance tax on their worldwide assets.
So basically, if I've been in England, I'm 17, I've worked, I'm now 30, I've moved out of the country, I'm now working abroad, I would still be liable for inheritance.
Yeah, that's it. So if you would, if that person was to pass, then you'd look back, and if you've been UK resident for 10 out of the last 20 years, then you come into UK inheritance tax.
So what if you have, say like I've been out of the country 20 years, mm-hmm. Am I not I don't have to pay inheritance tax?
So the only time then that you would have to pay or would be liable to inheritance tax is if you have assets still in the UK. So if you had a UK property, sterling bank account in the UK, then there'd still be UK inheritance tax on those assets.
Right. Okay. So that's one of the things on inheritance tax.
Yeah. So that leads us to how does inheritance tax get calculated. So on the date, if we look at the date of death, somebody's worldwide assets would get valued. So property, what cash they have in the bank, other investments, all of that will get valued. You take off any mortgages, loans, any debts that the person had in income tax. So the person will be liable to income tax up to the date of their death. You can also deduct reasonable funeral costs from the value of the estate. You can take off other exemptions that are available and reliefs, and then you get the taxable estate, and that part of it is taxed at 40%.
What if you're living abroad and you have been X amount of years and you've got debts in other countries? Is that taken?
Yeah, that's it. So all of your worldwide assets, all of your worldwide debts, if you're UK resident or long-term resident, all of that
it's
would
all
get
taken
included.
into consideration.
Yeah, exactly,
And that's quite something to calculate, isn't it?
Oh yeah, definitely.
For somebody to sort of like...
Yeah. So the person who would be responsible for doing that is normally sort of like the executor, or that they would be responsible for calculating all of your the value of your assets, or arranging for them to be valued and just putting it all together.
Because that could be a cost, couldn't it?
Yeah, definitely.
Putting all that together.
Yeah.
I mean, if you're using solicitors and things like that, there's costs.
Yeah, exactly. And it is one of those things where it's good to get the professional advice. Yeah, that's it. And so once you've looked at that, so 40% rate, there is a 36% rate, and that is if you leave 10% of your estate value to charity, then the rest of your taxable estate gets taxed at 36% instead of 40%, as a way to sort of encourage that donation to charity.
Is that what it is? It's trying to encourage people? Do you get a lot of people leaving big sums to charities?
I'd say mostly people
without families.
Yeah, exactly, without families. So families tend to come first. There might be smaller cash gifts to charities, but I know charities do really rely on those sort of legacies, and it can make a big difference to the charities. When they do get that income.
Yeah.
So everybody gets a nil rate band, and that is currently $325,000. So that's the value of your assets that you don't have to pay inheritance tax on. And that has been in place since 2009, and it's set to be in place until 2030, that 325,000. So you can imagine how much property has gone up in value in that time, and but that threshold has stayed the same.
That's really interesting, because when it started, obviously a house would be valued so much less compared to today.
Yeah.
So it's a big loss.
Well, that's it. It brings a lot more people into inheritance tax. Yeah. So you've got that nil rate band. If you leave your home to a direct descendant, and your entire estate is worth less than £2 million, you also get another 175,000, what's called residence nil rate band. So a person could leave £500,000 of assets and to their beneficiaries and not have to pay inheritance tax if the value of it was under 500,000.
What if you've got things like very expensive paintings, antiques? It all just goes in the pot.
Yeah, exactly. All just gets valued at a sort of fair value and added to the value of the estate.
And then anything over a certain amount, you pay a percentage in tax.
Exactly. Yeah, that's it. Now that 500,000 can be transferred to a spouse, so a spouse or civil partner. So in that case, between a spouse and civil partner, you could actually have assets to the value of £1 million rather than the 500,000, which could be left to your whoever you want, free of inheritance tax.
That is split between the two of you. You get 500,000 each, so theoretically you've got £1 million.
Yeah, exactly. And sometimes, as part of tax planning, if people are living together but they're not married and they have got a lot of valuable assets, we do sort of mention sometimes, is there a reason, or would you consider getting married, civil partnership, just as not the most romantic proposal ever, but it's
so even at that stage, it is more beneficial to be married.
Yes, yeah, exactly, yeah.
So, well, I thought that for some reason I thought that if you'd been with someone X amount of time, it all became.
No, it's only when it's married to civil partner,
still.
Yeah, and the main sort of benefit of that for inheritance tax is that anything that you leave to a spouse or civil partner passes exempt of inheritance tax. There's no inheritance tax to pay, and that can be any value. There's not a cap on that.
So if you're if you're with somebody and you sold your house for £1 million and just decided not to rent, is there any tax liabilities there?
So if you sold your personal home, then there wouldn't be any capital gains tax, and then depending on what you did with that cash, you could gift that money to
members of your family,
to somebody, and that's what's called a potentially exempt transfer. So if you gift cash between individuals, that is there's no inheritance tax to pay if you survive 7 years after the gift. So if you survive up to 3 years after the date of the gift, then all of the value of that gift comes back into your estate when you're valuing your estate.
So you're taxed on what you've been given.
So yeah, the estate would. So
say my mother died, or my mother hasn't died. She's gifted me £1 million.
Yeah.
3 years later, she does die.
Yeah.
I've got to pay the tax on that £1 million.
So the estate would pay the tax. Yeah, it would be calculated as part of the inheritance tax on the estate. What have I spent it? Well,
because when you think of it, 7 years is a long time to hold on to the money.
Yeah, I think there's normally other assets, and you do sometimes get time to pay, so you can spread the inheritance tax over 10 years if you need time to pay. But yeah, if there's big sums involved, then obviously you need to bear that in mind.
Yeah, because no point rushing in knowing that a member of your family might not live long and suddenly gifting everything over. Yeah. I think is that a popular way to do things, gifting?
I think gifting in lifetime is really useful. So there's a few ways that you can do that. Obviously, gift to spouse, civil partners that we talked about, so that's exempt of inheritance tax. Everybody can gift £3,000 a tax year. And again, that wouldn't come into an estate on the calculation for inheritance tax. There's also small gifts, £250. You can gift on marriage, so a mum and dad, if the child gets married, they can gift £5,000.
There's no limit on that.
So that limit, the £5,000. So a mum could gift £5,000, and it would be for a marriage. So you couldn't give
as part of the marriage.
Yeah, exactly. So when they get married, you give a £5,000 gift, so that wouldn't be brought back into the inheritance tax
anything over that
calculation.
potentially could be.
Yeah, exactly. So you'd have to look at the estate as a whole then. So if you give out of your income, so if you in later life have a very large pension and you're able to pay off all your bills and live comfortably, and you have some money left over, you can use that money to help pay a family member's rent or university fees or things like that. So as long as it doesn't impact your standard of living, then a gift out of income would be also exempt from inheritance tax.
Okay, tell us about gifting that. You gift your house to your children.
Yeah.
And then, but you said, but then you can't live in it.
Exactly. So a popular people think, oh, if I've got the 7-year rule, I'll just put my house and my home that I live in my children's name. As long as I live 7 years, then that's fine. And it can be, but if you carry on living in the property, then you're still getting a benefit from that property. So you either have to move out of the property and not get a benefit, or you have to pay your children, if that's who you gift it to, a market rate of rent.
It's got to be market rate.
Exactly, yeah, that's it. So you're not getting any sort of benefit as if you didn't own that property anymore, and obviously paying off the bills and things like that. Otherwise, it can still be bought into your estate after 7 years if you're still living in it and not paying the rent.
What if you had 2 properties? Mm-hmm. And you gifted one to your children and lived in the other?
Yeah,
that's fine.
So you can gift the second property. One thing to bear in mind on that side of it, if it's in lifetime, is that there still might be capital gains tax on your second.
What's the difference between lifetime and gift?
So a gift in lifetime.
Is that what we call it?
Yeah, exactly. Yeah, that's it. Would be separate from valuing your estate and paying inheritance tax on your death. So that would be.
And the gift is anything of any value, but as long as you don't die within 7 years.
Yeah, exactly.
So whether it's £1,000 or £1 million.
Yeah, that's it. There's no limit on that potentially exempt transfer. So as long as if it's cash or if it's anything else, then if it's a property or if it's shares, then you do have to bear in mind that there might be a capital gains tax implication, which is separate and we'll talk about another time. But it's just something to bear in mind that although it doesn't come under inheritance tax, there might be a capital gains tax to pay. That rate is still lower than inheritance tax rate, so it might still be worth you paying that capital gains tax for saving sort of 40% inheritance tax in future.
Okay, so that seems very reasonable that you can do that as long as you've got a bit of longevity to live 7 years. So now let's move on to trust. Why would you want to be in a trust? Yeah,
one thing I'll just mention on the inheritance tax, there's a couple of important changes coming up.
Okay.
So one of them is on your pensions. So currently your pensions, you can leave them to whoever, and they are outside of your estate, so you don't have to pay inheritance tax. From the 6th of April 27, the value of that pension, unused pension, will actually be brought into your estate. So what we could find in the future is that there's quite a lot of inheritance tax to pay at 40% on a pension pot that today you wouldn't have to pay that inheritance tax on. There's also big changes that you might have heard about in the press for agricultural property relief and business property relief. So currently, again, for that, you can get 100% relief on the agricultural value of land that you own and farm on. And you can also get 100% relief from inheritance tax on business property. So that might be the value of your sole trade, partnership, unquoted company shares that you own. So currently you get 100% relief. From 6th of April 26, that relief is 100% relief up to £1 million, and then it drops to 50% relief after £1 million.
Wow.
So again,
that's massive, isn't it, for the farming industry?
Yeah, definitely.
And because their assets are going to be well over £1 million.
Well, exactly. There's a large amount of land there, and they're going to have to
This is family land they've had for generations.
Exactly. Yeah,
so
that's
potentially they could be losing. Well, they could lose their farms, basically.
Yeah, it might be the case that they have to split up the farm and sell off portions of the land just to raise the cash to be able to pay the inheritance tax, and then a smaller bit of land might not be viable anymore to run a farm. So, yeah, it could have quite
Well, of
massive
course, and that
consequences.
goes on because then the next generation have to pay the tax, the next generation have to pay the tax, and so it goes on. And how do you start recouping? You don't.
No, exactly. It's just another cost that they're going to have to
So
suffer.
that's why we're seeing all these problems at the moment with people protesting, because that is about that. Well, that's quite interesting. I think people should understand that why they're protesting.
Yeah.
It's quite a valid reason, really.
Oh, definitely. Yeah, that's it. It's obviously off the food supply.
It's a food chain, and it's important farming. I think it should be exempt from our general day-to-day stuff because it's completely different.
That's it. And I think the legislation hasn't been, I think draft legislation hasn't been released yet. So there is still time for them to look at it and
maybe
tweak
make some
it.
changes.
Yeah, exactly. Just
Okay,
to make
let's
sure
hope
it works for everyone.
Let's hope they do that then, or they'll be putting all their money into trusts.
Yes. Yeah, so trusts, there are different types of trusts available, and one of the things, one of the lifetime charges of inheritance tax is if you put assets like property or shares into a trust and the value of that is more than 325,000, the nil rate band, then you would have to pay a 20% lifetime inheritance tax charge on the value of the asset going into the trust. But obviously it's half the rate of the inheritance tax, so it might still be worth it. There are different types of trusts. So you've got the bare trust, where the person, the beneficiary, just, it's like they own the capital, or they own the income, that it's all theirs. So it's as if they owned it themselves, except the asset is in somebody else's name, and that might be if they've got like if they're under 18 and they can't legally hold an asset.
Why would young children be in trust? Would they be not born and there's a trust available, or their parents, something's happened, they've just been to a trust?
Yeah, I think the reason that, or one of the reasons that you have the trust is so that you can, as the settlor, so you put an asset into trust and you're the settlor. That asset is held in the name of one or two or more other people, and they're the trustees. So they decide what happens to that asset, and then the beneficiaries are the people who benefit from that asset being held in the trust. So what you can do as the settlor, you can say, these are people that I want to benefit, put your children's names down, but you want them to be, the trustees to be a family friend, so that you trust them to make the right decisions for the beneficiaries.
For the distribution of the money within the trust.
Yeah, exactly.
Can these trusts be set up where they're given like a monthly income?
Yeah, absolutely. So discretionary trust is probably the one we're talking about here, because then the trustees have complete discretion on what they do with the income that's in the trust and the assets. So if they wanted to, if the beneficiaries needed a monthly amount, then the trustees could agree to that. If they wanted some money to help buy a car or with university fees, then again, it's something that could be requested from the trustees, and then the trustees consider the wishes of the settlor and distribute the money accordingly.
The whole distribution of the money within the trust is the trustees.
Yeah.
So if there's any disputes there, how would you approach a dispute with the trustees?
Yeah.
You'd have to go to some legal element to...
Yeah, that's it. I expect there's lots of cases where the beneficiaries aren't happy, or there's a dispute between the trustees, and I'd say the settlor can write a letter of wishes, but the trustees don't have to follow that. It's up to their discretion.
What is the main benefit of setting up a trust?
So you leave it responsible with the trustees. So if you think that the beneficiaries might need a bit more help in managing the assets, or you wouldn't want to release all of the income to them in one go, and you wanted a bit more control over it, the trustees can have that control. There's also for something like the discretionary trust, it sits outside of the beneficiary's estate. So if there's a lot of property that's quite valuable that's in a trust, and one of the beneficiaries dies, then the value of those properties, although they've been benefiting from the income, the value of those properties doesn't sit as part of their estate value, so they're not paying inheritance tax on it, although they've had the benefit of the income.
So what if you and your two sisters are in a trust left from your parents, but your children are not in that trust, and and something happens to you,
Mhm.
how does your children benefit from the trust?
Um,
Because if you're basically getting the benefit from the trust,
yeah,
you theoretically would want to leave it to your children.
yeah.
But can you do that, or have you've gone, so now the trust is just for them two, and your children don't benefit?
Well, so if it's set up in a will or a trust deed, so those will be the places where it's documented who the beneficiaries are, and quite often it says my children and their descendants.
Will
So
benefit
exactly,
along the
yeah, that's
line.
it. So you can bring in generations after you by saying that there's.
Yeah, so there's things to get right when you're writing up a trust.
Oh yeah, definitely.
There's
yeah.
so many things there, like disputes. You'd have to work out if someone's in dispute, how if someone's benefiting more from another person. Like you said, the trustees are they're allowed to basically make decisions.
Yeah.
So they can give one person more than the
Mhm.
other,
Yeah.
and then the other could be very, very unhappy.
Yeah, that's it, and that's why it's very important that who you appoint as the trustees, that they are sort of sensible and that they know your wishes, so that you try and avoid situations where it was unfairly distributed.
So what if there's a dispute between the trustees that you've got two trustees and they don't agree that they want to pay Fred out his money? How do you solve these disputes?
Yeah, it's something probably legal advice or something like that, where it would have to, may even end up in court, and just, if there's or
Because there's a lot of money involved in these things and a lot of assets, and all those things can cause huge amounts of problems if people are not happy. It must be, to tie the trust up properly, you really do have to take some proper advice.
Oh, definitely, yeah, that's it. And we've got a specialist wills, probate and inheritance tax department, so they specialise in all of that area and helping prepare the wills and make sure that the person's wishes are
What level of
correctly
people would go into
documented.
trust? Is it only the wealthy?
Trusts are very complicated. Like, there is an extra level of complication, so you have to make sure that by having that trust wrapper that it's worthwhile. Can you, and that's where professional advice can really help, because can you get can you achieve what you want by doing a gift in lifetime rather than putting something in a trust? Or there are lots of other ways of potentially maximising what your family benefits from, rather than, it doesn't always have to be a trust, but trust can be really valuable. The thing to bear in mind and weigh up is that something like a discretionary trust, it has its own tax to pay. So the trust has to do a tax return. It has to pay tax on its income. So if it gets dividend income, it's paying tax at the highest rate, 39%. If it's getting other income, like interest income, it's paying tax at 45%. There are 10 yearly charges as well, where you have to value the asset every 10 years that's in the trust and pay a maximum of 6%.
So even though I've put all my property into a trust, that trust now is really like a business, where if those assets go up, if I'm gaining interest, that is done in a way where you pay tax on that separately, and the beneficiaries just get money from. So this is run as a business.
It's its own separate entity, the trust. Yeah, it has its own tax responsibilities, which the trustees manage.
And do the trustees take an income from it?
So the trust can pay reasonable management expenses, and also if you were on the will side of it, if you had an executor, you can leave a certain amount to help cover their expenses in the will. So you wouldn't want people to be seriously out of pocket by helping you out managing.
Well, if you had several properties, it's a full-time job, isn't it?
Well, it depends how much arguing there is between the beneficiaries.
Because it could be quite a lot. I think it's really interesting, the trust thing, and I think it's a lot more complicated than people feel. I think when people go into that, they should really look at it. But I think it is more beneficial for people who have got quite a lot of wealth. Yeah. I think the gifting process would benefit people who have got lesser assets.
Yeah, that's it, and that's where it's sort of weighing it all up and making the best plan, and so that's why important. Get the tax advice in lifetime.
Would you advise people to do a trust or a gift?
Yeah, definitely. So we look at the options, and then if it's coming out that the trust will meet most of their requirements, sort of get them the best outcome for, because it's not just the tax side of it you look at, it's, that control, having the control of the assets
And
as well.
and your family, whether you feel they're responsible enough to actually look after the assets of the family, and then because obviously you want to keep the assets within the family so that they benefit from it long term.
Yeah, exactly.
As a family.
That's it, and that's what a trust can be really useful for.
Yeah.
So it's balancing all of the tax and the admin and what you actually want in terms of control.
Yeah. So your advice is to take proper advice. You give that advice.
Yeah, we do.
Clay Ratnage and Company.
Yes.
So if people are interested in that, they can contact you direct.
Yeah, definitely.
And then you can give them, because you've got a whole department that deals with that.
Yeah, we've got a specialist department, and so they can look at all of your assets and give you some really good inheritance tax planning advice, as well as deal with probate and inheritance tax, when the day comes.
Yeah, so we're going to touch a little bit next time when you're here on wills.
Yeah. Because
obviously, a lot of people haven't got a will, and that would benefit, and that touches on all the stuff we've been talking about today.
Yeah.
So I think that's going to be a really interesting subject. So that's something that we'll talk about next time, and I'm sure you're going to have other things to talk about. So thanks very much for coming in. I know it's taken a bit longer than we expected, but I'm sure it's all been worth it, and people are going to benefit from all that wonderful advice on trust and heritage. I'm really interested in the gifting. I think that's made it a lot clearer for me on the gifting. The trust, haven't got enough to go in it yet, but it's a really interesting thing as well. So thanks very much, Lorraine. Thanks for coming in. I'm sure I'll see you again shortly.
Thanks.